Welcome to this credit grid presentation on wealth versus income and profit versus retained earnings. This segment explains the relationship between the flow of money versus the accumulation of money and other assets. Let's start with the idea of a net inflow. Net inflow is equal to gross inflow minus gross outflow. If the inflow is greater than the outflow, the net inflow is positive, or vice versa. Let's start with a discussion about how this applies to households first, and then we'll circle back and talk about businesses. For households, inflow can include gross income that the household receives from wages, salaries, rents on properties, dividends from stock, etc. Gross outflow for a household includes all payments made for goods and services, for consumption, for their housing, for their food, clothing, etc., and of course, their tax payments. When inflow is greater than outflows, a household has the opportunity to either save or invest the residual money. Accumulations of cash in banks are called savings. If a household's residual cash is used to purchase growth-oriented assets such as bonds, stocks, precious metals, real estate, and more, those saved dollars are then converted into investment. Household saving in banks and bank-like institutions plus investments are an important part of wealth of a household. As wealth increases, of course, households then have the opportunity to make even more income from that wealth through interest and dividend gains and rents, etc. So, the accumulation of wealth becomes an important engine in creating additional income. Now let's talk about businesses. Gross inflow for a business includes sales revenue received by selling goods and services that the company has for sale. Gross outflow for a business includes payments for costs of goods sold, overhead costs, interest payments, payments to principal on debt contracts, payments to taxes, and also payments for wages and salaries of employees, etc. For a business, if gross inflows are greater than outflows in a particular period of time, the business has net income, which is sometimes called earnings or profits. Net income can be either retained by the business for investment back into the company or paid to the owners. Investment back into the firm using retained cash is a good idea for generating higher rates of growth in the company at relatively low cost versus borrowing the money from a bank. The best run companies use their retained earnings as an important source of growth funds for their firm. Using debt, of course, is an important part of business operations, but it must be done wisely and carefully and keeping within normal bounds for the industry sector in question. So in summary, the only way that wealth balances for households increase is if inflows are greater than outflows. The same is true for retained earnings for businesses. Cash flow management is critical to building wealth. Cash flow management is also critical to business growth capability. So whether you're talking about a business or a household, the only way for retained earnings or wealth balances to rise is for inflows to be greater than outflows. The result is that when you have more wealth or more retained earnings, that those balances can actually create more income, and more income there in turn creates more wealth. It's a cycle. So whether you're talking about businesses or your home, cash really is king. Thank you very much. This video was brought to you by Credit Grid, your source for business credit knowledge.